Hey guys, my name is Max Convexity. Welcome back to the channel. I really appreciate you guys tuning in. I got a good one for you today. Petrocelli strikes again. All right, the Zega Empire strikes back. So unfazed by what the boys over at Neos and Curve have been doing lately with their fund of funds and their split beta, their split beta fantasy, YieldMax drops a new filing just today. So it's a big one. And actually, I don't know if it's new. It could just be a refiling. I think I've seen these names before. But anyway, these are big names that people will be excited about. I've been asking for the upside to be uncapped for a long time from a strategy standpoint. And so we get a look at the prospectus, and Jay's uncapped the upside. So he's, if this was a poker game, he took a look at what Howard did, he's raised pretty much, or definitely. I'd ask Howard to uncap the upside too. Howard's fund would be perfect if it had uncapped upside, but Howard's doing it a different way. So Howard will be fine. All right, so let's check out the filings. All right, so here it is. So yeah, this is really exciting. I mean, these are some good names in here. This is going to be great for YieldMax. This means YieldMax will have 35 names. When it has 35 or, someday it'll probably have 50 names or something, it's its own index. The NASDAQ is there's the NASDAQ 100. Well, I mean, you could call it the YieldMax 50 or whatever. They've made their own index of tech stocks. Anyway, these are some names that, that I think will be interesting. We have Baba, Alibaba, Carvana, DraftKings. The symbol for DraftKings is DRAY. Thought that was interesting. Hood, the symbol is Hui. That's a good one. JD, the symbol's JDY. Mara, symbol's Maro. PDD, the symbol's PDDY. Planeteer will be a good one, so that's PLTY. Roblox will be a good one, RBLY. Shopify, so it's going to be Shoy. SMCI is just going to switch to SMCY. And then Taiwan Semiconductor, it's going to be TSMY. Boy, that one could be right in the middle of some interesting world geopolitical events here, potentially. But in any event, so those are some good names. No indexes or whatever, but that's fine. So let's just review BABA. They're all the same prospectuses. Let's just review BABA. And like I say, the same thing goes for all of them. Management fee looks like 99 bips. Standard deal. Okay, principal strategy. So the fund is an actively managed ETF that seeks current income while providing indirect exposure to the gosh darn it. While providing indirect exposure to the share price, i.e. the price returns of the stock, in this case, BABA, B-A-B-A, the ADR BABA. All right, so which is generally subject to a limit on potential investment gains because they're doing covered calls. The fund will employ an investment strategy as it relates to BABA, regardless of whether there's periods of adverse market economic conditions, and will not take temporary defensive positions during such periods. They're just going to keep writing. They're going to keep doing synthetic covered calls. All right. As further described below, the fund uses the synthetic covered call strategy to provide income and indirect exposure to the share price of BABA, which is generally subject to a limit on potential investment gains as a result of the nature of the option strategy it employs, namely the covered call. All right. In addition, the fund will at times opportunistically sell a credit call spread described below instead of selling call options when Zega Financial, IEJ, the sub-advisor, believes doing so would be more advantageous to the fund's total return. The fund not only seeks to generate income from its options investments, but also to derive gains from the value of BABA's increases. The fund's option contracts provide. So when they do these opportunistic credit call spreads, they're still going to be making an income, but they'll make less of income because instead of just selling a call where you're fully capped, they do a call spread. Well, the spread part uncaps some of your upside. So it's going to be interesting, but it also costs you usually about half your income, and it depends on a stock to stock thing. So it's going to be interesting. Now, I think the interesting part is going to be, I think they should just do it and just leave it on call spreads all the time. I don't know why you always want your upside uncapped. I mean, who needs 60 or 80%? I just don't get it. These things pay 100 or 80 or 60 or 50%. You just, no one needs that much. You can, there's funds will pay you that much, but there's repercussions as we found out, as holders of Tesla have found out, there's repercussions. But of course, on the other side, if holders of NVIDIA have had the opposite experience. So it's not like these are bad funds. They do what they're designed to do, but they aren't for all markets. For sure, they aren't for all markets. But in any event, I just wish they would just do call spreads on everything. Just pay about half as much. Just make everything a call spread. If it did pay 70, go for 35 now. I mean, if it paid 100, try to, spread it off and get 50, but preserve some upside. I just think it's a great plan. The funds will have a better total return. Now, people that are chasing yield or whatever, some people probably really like that 100% return and 80% and 70%. And I get it. But I think that these funds could do spreads full time, pay about half, even a third as much. It'd still be plenty of money for everyone's retirement. Everyone would have a great retirement, and they wouldn't have to worry about the NAV depletion element of these investments. All right. Well, that's my take on it. So let's see what else. That's my take on the opportunistic call spread, but I'm glad he did that. So this is the second or third prospectus I've seen from Zagan the past couple of weeks that had that same verbiage. And I think they're just going to put that in all their prospectuses. And that's great. No one else does that. The only other people that have call spreads in their prospectus is SPY, I believe, but I don't believe they've ever actually used a call spread, but they are able to as part of their strategy. But in any event, I think Petrocelli is really revolutionizing it. But also don't forget, I speak with Howard Chan tomorrow from Curve. I speak with him at 12:30. And I may do a live stream. If I don't do a live stream, I'll post it right as soon as I'm done talking with them. All right. So let's see if there's any other surprises. Synthetic covered call strategy. We know about that. It just says standard stuff about option contracts. I'm just trying to find out if it gives us any more clues. Synthetic long exposure. I mean, if I had a nickel for every time I've said the word synthetic in the past 6 months, covered call writing, that standard strategy, okay, the opportunistic strategy. Let's see if there's anything else in here that any other hints, there's something that I might like to talk about or something. I think it may have been the thing I just read. Yeah, the sub-advisor will primarily employ the opportunistic strategy when it believes that the share price of BABA is likely to rise significantly in the short term, following a substantial sell-off or overall positive market news. So basically that says they can do it when the market's going down, because after a big sell-off, they may want to do the opportunistic strategy because they're thinking it's going to bounce back really fast. But then the counter example was, and then it says and then it mentions pretty much to me the opposite scenario, or overall positive market news. So if they get in something like NVIDIA where it's going up every day and there's a tech rally and you don't want to cap your upside, hopefully they can, they have something that's blowing up, use the opportunistic strategy. They have something that's way oversold and they think it might bounce hard, use the opportunistic strategy. And maybe in all other cases, they'll use the standard strategy. Of course, I'll ask Jay, and I'm sure he's been on other shows as well. And Other people will ask them, but we'll see what the idea is. But I imagine that's what they do. I imagine it's something like that. All right, let's see. The rest of it looks pretty standard. Treasuries, monthly distributions, that's good. Funds portfolio, okay. So this is just, definitions. All right, well, I think we've seen enough prospectuses. I don't think there's going to be a real surprise. I think at this point, it's boilerplate. I'm just looking for anything that looks new. They have this paragraph in every one of them: NAV erosion risk due to distributions. When the fund makes a distribution, the fund's NAV will typically drop by the amount of the distribution on the related ex-dividend date. The repeat of payment of distributions by the fund, if any, may significantly erode the fund's NAV and trading price over time. But that's all standard. That is all standard. Performance, no, that's all standard. Okay, one thing I did notice, another change I did notice, is in the managers. I think they've had I think they had a portfolio manager at Zega that's no longer there, because I'm not seeing their name in the prospectus anymore, but I'm seeing a new name instead. And it's not Jay or Chris. I've met Chris and Jay before. It's the third person right here. So anyway, maybe I'll get a chance to meet that portfolio manager soon. They're actually a CFA, which is more than Jay and Chris can say, it looks like. It's pretty impressive. Nice. Jay has the most important qualifications, though, and that's the fact that his name's on the door. It says founder next to his name. So, that's all that matters. But in any event, it is impressive to be a CFA. Congratulations. Okay. So let's see if there's anything else in here. It just has standard stuff about tax information, but I'm going to ask, I want to get, especially with Howard tomorrow, into some more depth as far as the tax harvesting that these funds are doing, and with which ones are better at paying return of capital, i.e. being more tax efficient. Anyway, I have some questions along those lines for Howard tomorrow. But in any event, okay, so they have that standard prospectus for all of these. So which ones of these are you guys excited about? I mean, I just like the more the merrier. I mean, my theory is when YieldMax has 35 or 40 or 50 companies in it, that removes you're going to have a couple of Teslas, that just bleed, that reverse split. You're going to have one or two of those. But if when YieldMax only had, 10 or 12 stocks in there, you had one or two of those, it was really disastrous. But when it has 30 and 40, those single stock risks will totally go away, and they pretty much are making their own big index. Now, of course, even though it's their own index, they're still going to be vulnerable to stock market risk. If the NASDAQ crashes, so will the YieldMax, fund to families for sure. It's not like diversification protects you in every circumstance, but the more you can spread it around, the more you can prevent a bad underline from hurting you. And that just happens sometimes. That's what happened with Tesla last year. Next year, maybe it'll be a different underline that's bad, but you don't know what it is. But when you have all the YieldMax funds, if it's one or two of them that are bad, that sucks. But you also are going to have one or two in there that are good, is the idea, like NVIDIA and, some of these ones that are up double or triple already. So in any event, I'm excited about all this. Like I said, let me know which of these funds you guys are excited about, or just excited about in general about YieldMax. I'm just excited about that people are buying these so they can release more of them, and there's more variety coming out, and people are just learning about options and accepting how to use them and stuff. Then this is literally, you look at the returns of this type of investment, a diversified, high yield covered call fixed income portfolio, even a real conservative one. You look at the returns of that versus the returns of a decently conservative bond, in other words, last generation's fixed income investment, maybe bonds, senior loans, and some REITs, pretty nice conservative allocation. You might get 6. I mean, that's doing really good, 5 or something, but it's really realistic with these high yield covered call strategies. And I'm talking in conservative, funds like JEPQ and QILD, and also other ones that are a little bit, less risky. You could easily get a 12 to 15% return with a ton of safety. So that's double what you can make on the fixed income portion of your portfolio, whatever that is. Some people do 60-40, but I wouldn't go all 40% of that in covered call funds, but even a portion of that, even half of that in covered call funds, it's a big premium over what the kind of money that was available for people that were retiring a few years ago. And if you're willing to step out a little bit in risk, it's easily possible to make 25-30% yield on these. If you take more risk and if you pick the right ones and stuff. So, and more. So it's a great time to be an investor. But like I say, even the totally safe covered call portfolio it does about double what the last generation's fixed income allocation would do. So that's why I'm excited about it. All right, guys. Well, I appreciate you. Hope you have a good day, and I'll talk to you later.